This is the All-Star Charts podcast with JC Peretz. On today's podcast, JC sits down with Jonathan Krinsky, Chief Market Technician at Bay Crest Partners, to discuss sector rotation and what it's going to take for the stock market to have a severe pullback. These two guys have known each other for many years and are both chartered market technicians that speak to many of the largest portfolio managers in the world. This was a good one. Enjoy the show.
So Krinsky, yesterday we were tweeting out about sector rotation, and I was sort of, trying to put out there, I'm like, hey, listen, if we're going to have a severe correction in stocks, we're going to be under pressure for some time, maybe a couple of months or longer, who knows? There's usually a sector that you can point to and say, aha, that's the one that dragged us down, whether it's financials or energy in the past, or different cycles have different culprits, if you will. And right now, I'm just not seeing that place that we can point to and say, aha, that's going to be the sector that's dragging us lower. Those are the underperformers, and then the leaders are going to catch down, right? We haven't been seeing that. In fact, it's been the opposite. The laggards have turned into new leaders, and we've seen rotation among sectors. We've seen rotation down the cap scale, which, as you and I both know, is the lifeblood of a bull market, right? So let's play devil's advocate. Let's figure out what could possibly go wrong, where investors moving forward could potentially be much more rewarded for shorting stocks than buying them like they have since last spring. Talk to me.
Yeah, so I agree generally. The thing that I tweeted back to you is that we actually have seen a scenario where the market went into a cyclical correction without kind of those cyclical sectors or some culprit. That was January of 2018. And what I highlighted was that almost every single sector hit an absolute price high concurrently with the S&P on January 26th. I think energy might have been a couple of days before.
Of what year?
Of 2018, January 2018. So you had a great trending mark in 2017. It kind of closed. It was one of the best years we've seen in a while, kind of closed at the highs. January comes around, huge surge of momentum. Everything was firing all cylinders, not too dissimilar from what we have now. And again, into that January high, almost every single one of the 11 S&P 500 sectors, even the defensives, were hitting an absolute high concurrently on Jan 26th. Now, you mentioned that there's always relative weakness, and by definition, there always is relative weakness if you're looking at the 11 S&P 500 sectors.
There has to be relative weakness. They all can't be outperforming.
And if you go back there, the obvious laggards, as you would expect in a rip-roaring market, were the defensives, so the REITs, the utilities, and the staples. Now they were hitting, again, as I said, they were hitting absolute highs, right? So the consumer staples actually went on to peak a couple days later, Jan 29th. Utilities peaked on, utilities actually made an absolute high back in November of 17. So they did peak a little bit prior. And then the REITs made a high in December. So they were showing a little absolute weakness, but big time relative weakness. But I think that just brings up, generally speaking, you are correct that in a major kind of cyclical market where you want to get out of stocks, you're going to have that culprit. You're going to have, some cyclical out of the market, financials or industrials or semiconductors, something like that's going to show relative weakness. And we don't really have that right now. But you can also have, kind of these euphoric blow-offs, and that's what we had in 2017, where it's almost the opposite, where you have everything firing all cylinders, and then once everyone's all in, there's nothing left, and you kind of see the balloon deflate a little bit. I don't necessarily think that's what we're seeing now because, and you've been talking about this a little bit, and I agree with you, the mega cap stocks have been basing and consolidating since the summer. So we actually had that situation in the NASDAQ in August, if you remember. The FANG stocks were just absolutely ripping. You had this kind of parabolic blow off into late August, early September. But then a lot of those names have done nothing since. And Netflix was kind of the first FANG stock out of the gate to report, had a good reaction off earnings. So I think, we have to be under the assumption that some of the other names like Facebook and Amazon, Microsoft, Apple, et cetera, given their price pattern, are at least going to hold serve, if not kind of break out to the next leg higher. So that's going to actually insulate the S&P and the NASDAQ somewhat. Now, if we were to see a negative reaction and kind of, gap up, fade, and just straight selling in those names as we get through earnings, that would be a change of tone, and that would be a bigger concern for the market. But, that's kind of the difference. The main areas of the market that are, we would call frothy, are certainly some of the EV stocks. And then, of course, the last couple of days has just been this absolute explosion in the most short about this. In a note yesterday, the most short index, Goldman most short index, relative to the S&P, has outperformed by 45% over the last 10 weeks. That's by far the biggest on record. And that was before today, before we had at one point, we were up another 10% on the short index. So just seeing some unbelievable moves in some of the shorted names here.
Yeah, I mean, listen, stocks are doing well, and shorts tend to get squeezed when stocks are doing well, right? That's how I look at that. And these really aggressive shorts have really been getting screwed, right? Which is, I think we're in a bull market. I think that makes sense. Now, I want to play a little game here, right? So, the market never likes to make it easy on us, as you and I have probably both learned the hard way a bunch of times. But the easy sort of kind of like, the easy answer here is small caps, mid caps, micros. They've gone absolutely parabolic, while these mega cap names have done nothing for 5 months. The easy answer is you get rotation back into those mega caps. You get some consolidation in in the SMIDs, if you will, right? And the bull market, quote unquote, can continue, and we just get rotation underneath the surface in different sectors, and more importantly, the cap scale, right? To me, that's like the easy answer, but the market doesn't like to ever make things easy and obvious. So what is the other side of that? That these consolidations in the megas resolve lower, and the small caps and the mid caps catch down, as opposed to the megas catching up? Is that the other side, or is there a third possibility?
No, I think that's right. And I guess Netflix coming into earnings, as technicians, I know some technicians like to predict price action on earnings. I'm not one of them, but I do think the setup going into earnings can be very important. And Netflix coming into earnings was not really doing much. It was actually at a multi-week low, and we had that Netflix actually peaked back in July, right? So even had a longer consolidation. So the setup was pretty good as far as like expectations have been lowered. The issue is that kind of kickstarted it, and a lot of the other FANG names have since rallied. So Apple actually hit a new all-time high today, and they don't even report until the 27th. So we have a couple more days. So if Apple were to say run, another 5 or 10% into the numbers, that makes it much easier to be a sell the news reaction. And you could say the same for some of the other names. So yeah, that's the downside scenarios. You kind of have this run up into the numbers. You don't get the reaction that you got out of Netflix. And then these mega cap names are not helping the index. And then you have, as you talked about, the small caps and mid caps, and even like the semiconductors are at spreads versus their long-term trends that we haven't seen since 2000, if not ever. So things are very extended on a historical basis. Again, doesn't mean they can't get more extended, but the risk reward is not the same as it was, let's say in November coming out of a lot of these consolidations. So yeah, that's the other side of the coin, I guess. And to your point about about shorted names going up because we're in a bull market, that is true. But I think clearly the moves today, you saw at one point this morning, there were 60 names that were up 20% on the day. And those were on top of gains that we had seen, right? So it's yes, you would expect shorts in uptrends to go up, but it's getting a little extreme. And, GameStop certainly is at the forefront of kind of this speculative short squeeze action.
Sure. And, you and I could sit here and pick apart the market and point to things over the last 10 months or so that could point to froth, maybe not to this extent, but there have certainly been moments. Now, my question is, when it comes to talking with investors and allocating money on your own and all of these things, while the market is frothy, there are certain pockets of the market that are more frothy than others. So something like, I don't know, like these GameStop and these shorts or these small caps, like what does that have to do with Chinese internet? Or what does that have to do with like large cap medical devices? In other words, like, can we approach the marketplace and say, okay, would we rather be looking for stocks to buy or would we rather be looking for stocks to sell? And, is that still okay? Right. So that's kind of like the question.
Yeah. No, that is a good point. I think, look, as for our clients, a lot of them are long short. So you're always trying to find shorts that or sells that are not going to appreciate as much in a rising market. And conversely, you're trying to find longs that may not go down as much in a falling market. So I think, what you saw today actually was kind of maybe a little bit of a cautionary tale as to what can happen when you kind of get these massive unwinds. So we had from the open today to about 10:30 in the morning, you had that most short index up 10%, right, in an hour. You had certain names up 30, 40, 50, even 100%. And then as soon as those started to fall and reverse, the whole market came down with it. Now we recovered, and a lot of names recovered fine. That's fine. But I was getting a lot of questions. Why is the market selling off? You have to remember that there's a lot of money tied to the long short game. So when the short side of names that a lot of people are short and squeezed, they have to start selling longs to pay for that margin calls. So you saw a little bit of that today. So you do have to kind of view things, you kind of have to recognize the market dynamics a little bit. But yeah, I hear you. And there's, we are certainly not seeing any signs of important sectors breaking down. It's more a function of, do some of these areas need to consolidate? Semiconductors, the stocks is 40% above its 200-day. We haven't seen that in 20 years. Does that mean we have to come back to the 200-day and fall 30%? Of course not. But is it likely that we're going to see some consolidation like we saw in the NASDAQ from September to December? Maybe I think that's a pretty reasonable argument. So then you go, all right, well, what is timely? What can still be exploited on the upside? And that brings us back to those mega caps. Even some of the home builders have been pretty attractive. They consolidated for 5-6 months. So that's what we're trying to do, is find sells that aren't going to rip your face off if the market goes higher, and conversely find buys that aren't going to collapse if the market goes lower.
You make a great point as far as understanding the market dynamics, because sometimes people are like, well, the stock is up because of this. And it's like, you don't know that the stock is up because of that, or you have no idea why that stock is down. That stock could very well be down because of something that has nothing to do with that company. As you mentioned, there could be some hedge fund that had some monster position in natural gas that just blew up, and they're paying for that margin call with this XYZ that's getting crushed. It has nothing to do with who the CEO is or what the earnings are or lack of earnings or a news announcement or whatever it is that the media is making up. It could very well just be a function that some fund is blowing up in some other position and they need to unwind that trade. The obsession with trying to put a narrative behind every single tick up or down is ludicrous, right? You want to touch on that?
Yeah. Again, we talk about this all the time. We care much more about the what than the why. And, that's as a pure price and trend follower, that the what is much more important. So I think that's a good lesson. What else? The other thing I will say is, when it comes to trend following versus mean reversion, it tends to be somewhat more of an art than a science. I think last year was such a good year for momentum, right? The momentum longs just could do no wrong, and anything that had no momentum really couldn't do any right. The airlines, the cruise ships, they would have a couple days of a rally and give it right back. So, and that long short momentum can work, but I think you also have to recognize like how extreme it was. It was at one of the most extreme years for that type of strategy we've seen ever. So we're a trend follower to an extent, but when you start seeing parabolic moves, you kind of have to take a little bit of a step back and recognize that those probably don't last forever. And when we say parabolic moves, it's if you take a name like Plug Power, that was it was trending all summer above all its moving averages, but then the price appreciation as it went higher, the gains became bigger and bigger as it went up. So instead of having daily gains of 2-3%, once it started hitting 40 and 50, it was going up 10-15%. So when you start seeing types of moves like that, that gets me a little concerned.
So then what's the move? We're going into, what are we doing? We're ending the best 3-month period of the year. We're going into a seasonally slow month of February. Post-election years, it's the worst month of the year for February is. If the market's ever going to pull back, wouldn't this be a logical place for it to do so? Number one. Number two, do we just start fading everything just because things are overextended and we're heading into February? What's the strategy?
No, that's a tough question. I think the issue is a lot of time frame, and risk management. So if you're able to be nimble and you can bet against stocks, I think you can start to take some shots with defined risk for some mean reversion. But for longer term time horizons, maybe you just want to raise a little cash and kind of see how things shake out. But again, if we're talking about the overall market, you have to recognize that there's such, if we're talking about the S&P or the NASDAQ, there's such a large weighting in a lot of stocks, a lot of the mega cap stocks that continue to kind of break out of those 4 and 5 month consolidations. You're not going to see much downside in the S&P. So from our perspective, it's not like shorting the S&P. You want to kind of be picking select stocks. Again, I think I pointed some of the semiconductors. I think are again, it doesn't mean that they have to come down a lot, but I think the risk reward. And when I look at extended stocks, I'm not looking at RSI, and we know that overbought can remain overbought. I'm really looking at stocks relative to themselves over their lifetime and how extended they tend to get from their 200-day moving average. And a lot of these semis have not been this extended since 2000. Now, you could say, well, they got a lot more extended in 2000. I
was going to say, couldn't you say that in the fall too?
No, they were not nearly,
Not to this extent.
Semis are up, I think 40% since the election. But yes, that is by definition, that is the problem with mean reversion, is there's no absolute level. So I just think we're in the ballpark for some names, but I don't think, it's quite an overall market risk like we saw in January of 2018 or some other times when you've had, to your point, when you've had kind of the obvious sector culprits breaking down. We really just don't have any breakdowns of any kind at this point. So, to wrap it all up, I think you can be a little cautious. It's not a time to bet against the overall tape at this point. And there's still stocks to be bought. Again, we point to the home builders. There's still a lot of names with high short interest that haven't really broken out. A couple of them triggered today, but there's still names to find. I think it really is a good environment for stock selection and on both the long and the short side.
I feel like the US dollar, I feel like we're having a party in the dorms and we got like, a couple of mini fridges full of Busch Lights and we're 18, 19 years old and somebody keeps opening the door and checking to make sure the RAs aren't going to bust the party. I feel like the US dollar is the RA that we're watching. We get a ripper in the US dollar. That could be the RA taking everybody's beer away, right?
That's a good point. And actually, that was the other thing. I'm glad you brought that up because I know you've been pounding the table on global markets, emerging markets breaking out of a 13-year base. And I agree. It's not this 2000 or 2007 moment where everything is going gangbusters. And it's hard to say, the stocks as an asset class are frothy when you're just emerging out of a 13-year base for emerging markets, potentially a 20-year base for Europe. So that's a very good point. I really think
now Japan,
Japan, Taiwan. So it really is there's a lot of different things going on in the market, and you can't just paint it with a broad brush right now.
And that's the thing, right? What do these small caps going parabolic and some of these semiconductors have to do with Chinese internet or Chinese education or, right? You know what I mean? So I think that there's some different areas, but talk to me. Let's stick with that dollar theme. Like, where are you at on that? Do you think that would put a major damper on the market? Do you not think a dollar rally is even on the table? We roll over and start making new lows again and the party continues, right? Because in 2018, right, if we're gonna stick to this 2018 theme, that's when the dollar started to rally, and the dollar started to fall apart in March of last year when stocks started to rally, right?
Yeah. I mean, the dollar bottomed almost concurrently with the market. So, but it didn't really have a big move up until April of 2018. But yeah, I think a dollar snapback, all else equal, would be more negative than positive for a lot of assets. I think a big move in rates, either up or down, would also be risk off. But it's funny. It's all about when you're talking about moves in the dollar or interest rates. To me, it's not about the level. It's about the speed and the magnitude of which you get it. So we're at basically 1% on the 10-year. If we were to go up to 140, 150 in a couple of weeks, or back down to 60 or 75 basis points in a couple of weeks, I think that would spook some markets. But in converse, same thing with the dollar. I think if you get a swift, sharp move up, that would certainly have some negative implications. But I think if it's kind of this choppy, slow grind up, then I think it's not that much to worry about.
But wouldn't rising rates, wouldn't that be a tailwind for the financials, not just in the United States, but globally, right? Money coming out of bonds, looking for a home in the stock market, right? I feel like rising rates has been consistent or is consistent with higher stock prices. For me, if the rates keep going up, stocks are fine. It's if you see that rotation back into bonds, which maybe this week started that. And I mean, that's certainly a possibility. Rates may have started to fall apart today as we're recording this January the 25th. I have no idea. But that's what I'm watching. I'm not really concerned about rising rates, especially with rising commodity prices, which I also think would be a positive for stocks, no?
Well, yeah, there's always an offset, but I think a big spike in rates would have the biggest negative implications to growth tech, which has been kind of that's been the justification for high valuations and high growth names, and we know that they make up a very significant part of the S&P. So, it's obviously nobody knows for sure, but I think if you look at some of the correlations, yes, rising rates are good for financials and some other assets, but if you see a very sharp move up, you could see a bit of an unwind in some of those areas that have been kind of, again, justified, for a better word. They've been justified their high valuation. So, again, we'll see if and when we get that, but given today's action, it doesn't seem like that's necessarily an imminent threat at this point.
And what about the commodities? What about energy costs? What about base metals doing so well? Isn't that evidence of demand globally?
Yeah, no, commodities have been a very good sweet spot. Or you're talking XME, some of those, industrial metals and mining stocks, Freeport, stuff like that. They're basically reversing many years of a bear market. So, we don't know if that's going to continue, but we know that the trends have at least, we're talking, if we're talking like a Freeport, we're talking about a bear market that at least goes back to 2011, right? So we're talking 10 years.
Markets. I mean, like emerging markets, right? Been struggling for a decade.
Yep. So we had this huge surge starting, Freeport bottomed like the overall market in March of last year, but it's continued. So I think we've clearly at least stopped the bear market. And I'm talking about the structure. Obviously, Freeport's been in a bull market by many definitions for many months, but I'm talking about is that 10-year structural bear market over? I think clearly it is. The question is, do you need to buy it now, or do we want to see some consolidation after a move of 5 to 35? I think some consolidation in a lot of these names would be not surprising, and maybe if you get a little rip in the dollar, that would kind of coincide with that.
Yeah, I could see that. Now let's talk structure, right? You mentioned 20-year base in Europe, emerging markets flat for 13 years. You could talk about the U.S. financials index still below those 07 highs, going on 14th year of no progress. You could talk about Japan, Taiwan, all these things, Hong Kong. We can keep going, but at the end of the day, these are massive bases that you can argue have been in structural bear markets for so long. And I got people emailing me every day telling me that we're in a bubble and the stock market needs to crash. And then I'm looking at some of the most important stock market indexes in the world doing nothing for a long time. That just doesn't seem like a bubble to me.
Yeah, and I think you're starting to see more signs and evidence of some rotation into global markets. The relative lines of global markets to the U.S. are, they certainly haven't reversed these long-term trends, but I think you're seeing early signs of basing of global equities basing relative to the U.S. So, maybe we have a situation where you get some pause in U.S. stocks. That, again, doesn't mean they have to crash or go down a lot, but a lot of U.S. stocks could certainly use a pause, and maybe some of that money finds its way into global equities. As you said, the breakout in Europe, we've been waiting for years.
Since I was in high school, bro. I think you're a couple years younger than me, right?
Yeah, I was 02, so we've been waiting for a while. Still not quite there yet, but it's maybe it's early innings of at least a relative turn. But then it's a tough call to make that these shifts have happened, right? We know that there's little signs of it, but I don't know if we can quite say we've turned the corner yet.
No, you're not making that call? To me, it seems, we've been pretty confident about it since last summer, and it's been working. Emerging markets in particular, which obviously is a huge percentage. When you take the United States or North America in general out of the equation, and you compare emerging markets to developed markets, also, making new highs, which I think is interesting too, right? Because the U.S. has done so well, right? When you take the U.S. out of the equation, and now you're looking at Europe and Japan and Singapore and Hong Kong and some of these, emerging markets have been ripping relative to these things.
Yep. Yeah. EM has certainly been showing a lot of relative strength. EM's a lot different than it was 13 years ago, which we don't really care about, but I think, that certainly explains a lot of it. There's a lot more tech, a lot of beta tech in emerging markets. Taiwan is now 25% of Taiwan is Taiwan semi. So, there's just some things you got to be careful about, but certainly if you're just talking about trends in the EM or EWT for Taiwan, that you can't argue that they haven't started to break out on a relative basis.
What about precious metals? They can't get out of their own way, huh?
Man, yeah, it's lost in the euphoria. Everyone's in Bitcoin or highly shorted stocks. Last year was certainly frustrating in the sense. It's funny though. I think if you polled a lot of people and asked what did better in 2020, gold or the S&P, I think a lot of people would probably say the S&P, don't you?
Probably, but I mean, you're cherry picking starting points, right?
Certainly, but my point is that gold was up 10. Gold beat the S&P by 10% last year, and it peaked in August. So it actually was down from August to December as the S&P ripped in the last 2 months of the year, and it still beat it by 10%. So it just shows you how big of a move it had in the beginning of the year. And look, gold's still above a rising 200-day moving average. Silver is even a bit better. It's still above its 50-day. So I think, as long as the dollar kind of stays somewhat range bound, it doesn't spike too much, then, maybe we can get some rotation back into the precious metals. But yeah, it's been kind of frustrating for momentum investors over the last few months.
Man, you would have told me, probably you, a bunch of our smartest friends, what gold would have done, and you just give us a chart of the dollar and be like, okay, look at what the dollar did over the next year. What do you think gold did, right? You would have been like, whoa, gold would have ripped in the second half of the year. No.
Yeah. And same with the miners, as we know. GDX, no different, really.
But you believe in this gold? You think we're going to break out above those 2011 highs and finally get going, and we're going to see gold 3,000, 4,000? You think that's real, or we're going to struggle for a while?
I think eventually we will. I mean, I think now you really can't talk about gold now without talking about Bitcoin.
Even though the market cap is just a little fraction of the gold market. Yeah,
but I mean, you're starting to hear real money. Talk about some allocation in the Bitcoin that money may have gone to gold. So I think that's not insignificant. Clearly Bitcoin could use some real consolidation after it went from it doubled in a couple of months. But yeah, gold, I think until, look, anytime you have something that's above a rising 200-day moving average that's been consolidating for 6 to 8 months, you have to give that the benefit of the doubt to the upside. Until we see some distribution, some closes below the 200-day, starting to see those trends roll over, you gotta give it still the benefit of the doubt to the bulls. So it's been frustrating, but I don't think I would count it out just yet.
Yeah, we haven't been shorting it. I mean, I continue to point to the new relative lows that we're seeing, right? New relative lows across the board. So I mean, talk about underperforming. I'm not a fan of buying those underperformers, but it doesn't necessarily mean that we're going to short it. Because of the things that you mentioned, plus others as well, those long-term trends, the fact that we're not severely selling off from those 2011 highs, but kind of like just chopping around, messy, sort of absorbing that overhead supply, just kind of messing around. I don't know how long it's going to take, right? It could take another couple of months, could take another couple of days. Maybe it never breaks out. I don't know, but it's certainly paid to be patient.
And from a sentiment perspective, I mean, you're the first person that's asked me about it in a long time. I don't see anybody really talking about it on Twitter besides you, and you're simply pointing to the relative weakness. So I think it's kind of interesting, but there's no reason that if you're in it, I think it's fine. I don't think you have to start establishing new bets either until maybe you see some relative strength, or until you see that some closes kind of above the November highs, which was around 1965.
Yeah, because that puts you solidly above those 2011 highs, and we could say, okay, this is a secular breakout, right?
Yep.
What are we missing? We talked international. We talked emerging markets, precious metals, base metals, sector rotation. What's the big one no one's talking about?
I don't know. You got me.
We buying energy stocks or what?
We did like energy stocks. We do think they turned a corner. The 200-day moving average had been falling for a couple of years. It's now rising. You got price above the 20, 50, and 200. They're all stacked properly. So I think you can have some exposure to energy. If it doesn't kind of start getting some momentum again in the next couple of weeks, I might be a little concerned. But at this point, I think it's worth having some. I mean, you're fighting a long-term trend. You're fighting some secular trends, and some of the funds are literally not investing in energy stocks. So that's a headwind. But I think it's still worthy of some money.
Where? Refiners, explorers and producers, integrateds, the whole space?
I think E&P, because again, if it's going to work, you want the highly levered names, and E&P tends to be more highly levered. And some of those actually are already more of an established uptrend. So yeah, that's where we'd be looking.
And they're dependent on higher oil prices, right? Oil keeps going up for energy to do well, energy stocks.
I don't put as much weight on the correlation. I mean, oil's been pretty range bound, excluding the plunge into negative territory. Oil's been pretty boring, but I think the energy stocks tend to be a little bit more, have a little bit less correlation than people think to crude prices.
And while we're talking about this, commodities have been in a bear market for a long, long time, particularly relative to stocks. Was crude oil trading in the negatives the end of that bear market and sort of that final flush?
Yeah, I think we'll look back on that, and you could probably point to that for sure. And I think that, again, time will tell, but I think some of the moves we saw in the last couple of days in some of these highly shorted names could almost be an inverse of that. I mean, when you see a stock go up over 100% in a day, that is capitulation. So, but yeah, to your point, I think negative oil is certainly, if you're going to draw up an end to a decade bear market, that would be as good as any, right?
I mean, talk about a good start. Crude oil trading below zero.
Yep.
So it sounds to me like any mean reversion, any pullbacks in the market, your tone seems to be like it'll only be temporary. What do you think it'll take to get you to become Mr. Gloom and Doom?
I think if you were to see, again, some real negative reactions to some of the mega cap tech names in the coming weeks, whether it's earnings or post earnings. And, if we're talking about small caps, we liked them in October, November because they had been consolidating for 2 years. They're pretty well hated. So they broke out of a 2.5 year base. There's actually a lot of room to come back to almost retest that. It would be pretty ugly, but, IWM broke out at 172. It went up to 218. So there's some room for it to consolidate, come back, and still be in a structural breakout. But to get negative, you're going to have to start seeing some of the cyclical areas really start to break down, and or some of those mega caps, start to not do what they're supposed to, right? They're supposed to break out at this point. If they don't do that, we have some bigger issues.
Yeah, that's what I say. I put quotes on should. Like they should resolve in the direction of the underlying trend. But if they don't, that in and of itself is the signal, because the bear case seems quite obvious. The bear case seems to be these mega caps resolve lower and these parabolic moves in the SMIDs revert to the mean, right? And all that happens simultaneously, right?
Exactly.
That's the bear, right?
That's it. Yeah.
I love it. I hate that we're like so on the same page. Like I wish like we disagreed and we could fight it out, but it sounds to me like we're looking at the same charts.
Yep.
All right, man. Listen, let's do this again. I always enjoy catching up. You always have some interesting tidbits to look at. I think we look at the markets. We're trained in a very similar way, but we have our own little differences, right?
Absolutely. Yeah, I think I think that's right. I think I tend to look for a little bit more of mean reversion than you do, and I think we'll see if we get it.
All right, rock and roll. Listen, congratulations on the baby boy. I'm very proud of you. Welcome to the Dad Club.
Thank you. I got some couple months to get to your status, but thank you.
Man, I just hit the 6-month mark, and all my friends always told me when you get to 6 months, things start getting better, and it's true. We're seeing it. She's hanging out longer, right? So you see it.
Yeah. Good stuff.
All right, brother.
All right, take care.
That's our show. For all the charts and more discussions about the market, check out the blog at allstarcharts.com. See you next time.